All right. Thanks so much, everyone, for joining us. We had what we call a snowstorm that's a commuter special today. So in parts of the Salt Lake Valley, it decided to snow overnight. So a few people might still be lingering in joining us, but we'll go ahead and get started with a few housekeeping items. So let's see if I can. All right. So please do feel free to ask questions. I've left plenty of time within our presentation window for questions, and as much as virtually it can be interactive, I would love for you all to pipe in with questions or comments, just to help with the flow. If you will put your question in the chat feature, we'll be monitoring the chat, and we will make sure that we get those questions answered either during the presentation, or we'll leave time at the end in case we don't get to all the questions during the presentation. We will send the slide deck out to everybody at the end of the meeting. We also will record the presentation, and we'll post that on our website. So if you had someone, maybe that a colleague or someone that wasn't able to attend today and they'd be interested in viewing the presentation, we will make that available as well. For anyone who does want CPE, for those of you who are attending virtually, throughout the slide deck, there are CPE codes, just code words that you'll need to just write those down and then shoot me an email after the presentation's over with that CPE code. And then once I have that, I can then send you the CPE certificate. That's the way we have to do it if we're offering CPE when people are joining us virtually. So like I said, there will be 3 CPE codes throughout. Just jot those down and then shoot me a quick email at dnesbitt@larsco.com. Shows it on the slide there when the training's done, and then I'll email you a CPE certificate. We want you to get credit for spending time with us today, for those of you who need the CPE. And just our little disclaimer here, we're presenting things as they stand today. So just note, the information presented is always subject to change when we're talking about rules and regulations, right? They like to keep us on our toes. All right, so with that, we will go ahead and dive in on the presentation. Real quick, just for maybe those of you who aren't as familiar with the firm, our firm's Larson Company has been auditing employee benefit plans for over 25 years. Our firm is a member of the AICPA Employee Benefit Plan Audit Quality Center. As of right now, we audit just a little over 500 million in plan assets, and that's about 35 plans, 35 to 40 plans that we audit. And we're Utah's 13th largest CPA firm. Before we dive into talking about a bit about how the audit's going to look under some new standards, I just wanted to remind people about when a plan audit is required. So under ERISA, if a plan is brand new, just been formed, and there's 100 or more eligible participants, then the plan will need to be audited in that first year of inception. For existing plans that have been around for a while, once there are 120 eligible participants or individuals who have a balance in the plan, it's not just people who are participating. It's not just people who have balances, it's people who are eligible to participate, people who are participating, and those who have balances in the plan. Once that count reaches 120 participants, then an audit is required for existing plans. It's now required to file the 5500 as a large plan and submit the audit report with the form 5500. And like I mentioned a few minutes ago about regulators liking to keep us on our toes, there is a proposed rule that may change those participant audit thresholds. And what they're looking at doing is they are looking at excluding participants with no balance. So if someone has elected not to participate, not to contribute, and they don't have a balance, those participants would be excluded from that participant count when you're looking at if an audit is required or not. I participated in a training a little bit earlier this year. There was a representative from the Department of Labor, and someone asked a question about this pending rule, and he just really quickly said they didn't have anything to say about it. One way or the other, it's pending. The comment period is closed for it, but the DOL has not issued any response or guidance on that. Supposedly, it would be effective for plan years beginning on or after January 1, 2022. But again, there has been no formal guidance released, so we'll have to wait and see on that one. The other thing that I just wanted to touch base on really quickly are just some key things that you should be asking your auditor about, either if it's the first time you're looking to have an audit done of your plan, or on an ongoing basis, just doing some due diligence. Here's some things that you should be asking your auditor to make sure that the auditor is qualified to perform this type of audit. It's a unique type of audit. Employee benefit plan audits are very compliance heavy, and you just want to make sure you have a qualified auditor and that you're going to get that audit done in time to file with the 5500. I was like to put that last bullet point on there, that the DOL can assess penalties if the audit is either not appropriate or sufficient, or not submitted at all. They can charge a penalty of up to $2,000 a day. And if you don't pay it, they'll send you to collections. Unfortunately, I had a client that was in that scenario. We were trying to help them get caught up, and the Department of Labor called their head, told them that they were going to go to jail if they didn't pay the penalty for not submitting the audit report with the 5500. So the DOL wields a big stick. Okay, I'm going to dive into the new audit standards, but first I just wanted to pause and see if we did have any questions come in. It doesn't look like we did have any in the chat. With that, we'll dive into the next portion of the presentation. Oh, first I got to give you your first CPE code. For those of you who need CPE, jot this down. There will be 3 of them total. Just email those to me after the presentation. So the first CPE code is audit. One of my favorite words, since I am an audit partner. I guess I should have introduced myself real quick in case any of you don't know me. I didn't think about that. I am an audit partner with Larson Company. I've been here over 20 years, and I'm employee benefit plan audit practice for the firm. So quick introduction there while you jotted down that first CPE code. All right. So the part I'm really excited about is this new audit standards. It's SAS number 136. And this standard was supposed to be effective for plan year ends ending after December 15, 2020. And then COVID happened, and they extended the implementation deadline to 1 year. You could early implement if you wanted to. Our firm did not choose to early implement the standard. I know some firms did. Our firm chose not to. So the implementation date is for all plan year ends ending on or after December 15, 2021. So for all calendar year plans, the 2021 plan year is going to be subject to these new standards. So the audits that are up and coming this spring and summer, this new standard will apply for all of those calendar year end audits. Okay, so what's different? Let's hone in on the differences. So we talked about the effective date already, and the early implementation was permitted, but one major change with the standard is it limited what we all have commonly heard referred to as the DOL limited scope audit opinion. So there was a lot of unrest, I guess, if you'd say, about this limited scope opinion. The Department of Labor really wanted the audit to cover a lot more, didn't really like that there was no opinion on GAAP. And so this new standard is kind of the result from some of those discussions. So it's now going to be referred to as an ERISA section 103A 3C audit opinion. I don't know what the acronym or how we're going to shorten that. I'm sure it will get shortened. We love a good acronym in the auditing and accounting world. Maybe we'll just call it a section 103 audit, but That's the section of the ERISA code that talks about when a plan is required to have an audit. That's where that is kind of based in. So, and this is for plans where there is a custodian who will certify the assets. And so the procedures around investments and assets of the plan can be scaled back some. So that is where if you don't have that certification, we'll talk about that in a minute. If you don't have that certification over the plan assets, we'll talk about that in just a minute. So the new standard enhances auditor reporting relating to going concern and describes the respective responsibilities of management and the auditor for going concern. So that is something that's an enhancement. It expands the description of plan management responsibilities. So there are going to be some new written management representations in that letter that we ask you to sign and give back to us at the end of the audit before we release the audit reports. That will be expanded. There will be some additional items in there that are new, and we'll talk about those. All right. So then how is this going to affect those who are managing the plan specifically? On the auditor side, I didn't focus so much on that because our group here is mostly your plan management, the plan sponsors and plan administrators are those who are helping plan sponsors with day-to-day plan operations. So the plan management responsibilities have been clarified. A lot of these things were implied responsibilities, but with this new standard, they're now clarified and very clear that these are things that plan management must be doing. So first, on engagement audit acceptance, management must agree to maintain the current plan instrument. If there's a required amendment by law or an amendment, needs to be made on how the plan's operating, that all gets done correctly, put into writing, put in place in when it should be. Administer the plan in accordance with the ERISA plan document, just making sure you're following how the plan document is written. And then also plan management needs to provide the auditor a Form 5500 draft that is substantially complete prior to the audit report date. So substantially complete, they did give us a definition on what does substantially complete mean. And what they've said there is substantially complete means, sorry, I'm just getting to my notes so I don't speak incorrectly there. Okay, it's substantially complete 5500 is one that includes the forms and schedules that could have a material effect involving both qualitative and quantitative considerations on the information in the financial statements and ERISA required supplemental schedules. So definitely in my mind, that's Schedule H. And then those supplemental schedules that will be required to be prepared based on those answers in Schedule H, like your schedule of assets held or schedule of delinquent participant contributions are two common supplemental schedules there. And I know some of the trainings I've been to on this new standard, the practitioners that were participating, the CPAs that were participating in the training said, well, what if we're also preparing the 5500? Do we have to provide ourselves with a substantially complete draft of the 5500? And the answer there was a resounding yes. Like that needs to be part of the process. The 5500 needs to be drafted, even if you're also doing the audit, which is perfectly fine, but you need to make sure that you've gone through and gotten a 5500 draft prepared as part, along with the audit being performed. So, okay, so then management must also determine, let me admit a couple people, sorry about that. Okay, management must also determine if an ERISA Section 103A3C audit is permissible, and if the investment information prepared and certified meets the requirements of the CAFRs that where these requirements are outlined. And then if the certified investment information is appropriately measured, presented, and disclosed in accordance with the applicable financial reporting framework. So again, these are things that were implied before, that management was making the determination and making sure that this type of audit could be performed, but now these things are all need to be specifically documented. There is a tool that the Audit Quality Center has provided here to help management make the determination. I'm going to show this real quick, this tool, and it just to kind of go through and remind you what some of the requirements are, maybe as a refresher. Can you see that okay, that I switched to the other document? Perfect. Just wanted to make sure. Thank you. Okay. So conditions for plan management to elect an ERISA Section 103 audit. So first, it's going to talk about that you have the proper certification from a qualified institution. A reminder, a qualified institution is going to be a regulated entity that has to be audited themselves, which examples of that are an insurance company, a trust company, or a bank are the three most common that you see. So you can see here, those are the three options. There is this other agent that's qualified to certify. I'm not going to talk about that much because that's pretty rare. And then just documenting plan management considerations. Again, this is just a tool to help and make sure management understands and that the auditors documented what they should around these plan management responsibilities. And then the certification needs to be signed by an authorized representative of that insurance company, bank, or trust company. So you can't have like the customer relations VP be the one signing it. It probably needs to be like the president of the company or the vice president of the company is the most common that we'll see there, that needs to be, that they need to be an authorized representative signing that certification. And sometimes what we'll do there, like as auditors, is we might just look at who the individual is and maybe we'll just Google them really quickly, see if we can find them on LinkedIn or the company's website, and just do a quick double check that that person is an authorized representative of that company, of the qualified institution. That's a quick way to double check. And then the two keywords we look for in the written certification are both the word completeness and the word accuracy of the asset or investment information. For a few years back, there was an issue where companies were providing a certification, but it really wasn't speaking to the things that were required under the CAFR. So we're always looking for those key terms, both accuracy and completeness in the written certification. And then is there anything that makes you feel like maybe the audit package, the reporting package, the trust report is maybe not accurate or complete when you're looking at that information? And then lastly, the measurements of the certified information. That'll be your fair value measurements, your leveling requirements, those level 1, level 2, level 3 classifications for the footnote disclosures, that have they been appropriately measured in accordance with GAAP or the basis of accounting that's being used there for financial statement reporting purposes. And then just a conclusion. And then what we're doing is we've just modified, we have a client questionnaire at our firm that we send out every year with the questions we're required to be asking plan management. So we've added a section where we ask about this specifically. And then maybe if our clients have questions, we might go through this tool with them. If things are unclear or they're unsure, then we might look to this as a resource to help plan management understand that. But we'll start with some basic questions in our questionnaire. That's how our firm is going to work through that with our clients. So I'm going to go back to the slideshow here. And all right. So then that's all the things that need to happen now by plan management and audit acceptance. So that's new. And then at the conclusion of the audit, I'd mentioned before, there's going to be some new representations in that management representation letter that's required to be signed and sent back to the auditor before the audit is issued. And it really does mirror those same things we talked about at engagement acceptance. So I won't go through those each in detail, each of those bullet points, because it does just mirror what we talked about at engagement acceptance there. But that is what will be required or that's new in the representation letter. Okay, I'm going to check real quick to see if we have any questions. I'll give you your next CPE code too while I'm checking on that. So that CPE code number 2, clarify again, maybe for those who missed the very beginning when we talked about it. If you would like CPE for attending virtually today, you will need to jot those CPE codes down, send those to me, and then I can send you your certificate for CPE. So that second CPE code is clarify. Doesn't look like we've had any questions come in through the chat. So I will keep on moving. So another big difference here that's going to be new are this new category of what's called a reportable finding. So the auditor is now required to evaluate and communicate in writing if there are any reportable findings, and that reportable findings defined as follows. Now I've got a decent amount of information on this slide, but I just want to make sure that you all can use this as a resource or reference after the presentation today. So the definition here is an identified instance of non-compliance or suspected non-compliance with laws or regulations. And it's a finding arising from the audit that is in the auditor's professional judgment significant and relevant to those charged with governance regarding their responsibility to oversee the financial reporting process. And then an indication of deficiencies in internal control that are identified during the audit that have not been communicated to management by other parties, and that in the auditor's professional judgment are of sufficient importance to merit management's attention. So with this, maybe some of you who have been part of audits in the past, and you're saying, well, how is that any different from what was going on before? Oh, it looks like we do have a question that popped up about the certification. We'll put a pin in that and make sure we answer that right at the end. Sorry, I didn't see that sooner, but we'll come back to that question, make sure we get that responded to it at the end. Okay, so what's different here with this new category, this reportable finding? So prior to this new category, maybe what was happening here is these items may have only been communicated verbally by the auditor to plan management. An example here is, say, for example, the fidelity bonding requirements for the plan were not met. This may have been something that the auditor would communicate to the client verbally, and the client would, get back with the auditor and say, hey, we got the fidelity bonding increased, it's fixed. And everybody would have just moved on. It would have just been maybe documented in my audit working papers, but not necessarily communicated in writing to plan governance. So that's an example now where the auditor would need to, because it's a non-compliance issue, that needs to be communicated in writing now. So a little bit of more information on this topic. The auditor is not permitted to issue a written communication stating that no reportable findings were identified during the audit. So this might be something, that someone might request and say, well, can you represent to me, can you put it in writing that there weren't any reportable findings found? And the auditor is permitted from doing that. So this communication needs to be included with the required communication with those charged with governance. So what's that going to look like in practice, in reality? Previously, internal control findings, your significant deficiencies and material weaknesses, and then your required communications with governance were typically in 2 separate communications. So under the new standard, auditors will be likely to combine these into just one communication. That's a lot of the trainings that I've gone to, and there have been representatives from firms that implemented the standard early, and that is what they had chosen to do. It just streamlines things and simplifies things, and helps everyone make sure that all that written communication is being done correctly. So most likely you'll see your internal control communications letter and your communications letter put together in one letter. So the reportable findings communication, that should include a description of the reportable finding, sufficient information to enable those charged with governance and management to understand the context of the communication, and an explanation on the potential effects of the reportable findings on the financial statements of the plan. So I wanted to go through a few more examples just to help kind of solidify this on, well, what's it, how's it really different from before, or what's it going to look like, so that you as plan management individuals, you won't be surprised when the auditor comes back with all these things in writing and you're like, what's going on? Why is this all in writing all of a sudden? Are you guys mad at us? But it's not that. It's that some of these things that we've noted in the past and now need to be communicated more formally. So, and another example of a reportable finding would be that there's not been minutes kept for planned board meetings, or maybe there haven't been any planned, investment committee meetings that have been happening. This is something that the IRS and the Department of Labor would look at if the plan was ever selected for an audit. They want to see that there is at least one meeting and that minutes have been kept to that meeting where, plan amendments are being approved, where you're talking about your fee benchmarking. That's an example of something that's really common that we want to see happening and being documented in board minutes. So if that's not happening now, that's going to be a written reportable finding, as opposed to maybe we just communicated that verbally in the past. And I mentioned this one earlier. If the fidelity bonding requirements for the plan were not met, this will be something that will be put into writing. And additional examples of reportable findings. This is also where that will overlap with those internal control deficiencies. We've always been required to communicate in writing, and those are the significant deficiencies or material weaknesses in internal control. So some examples here where they're both a reportable finding because it's an issue of noncompliance, but it also could be a significant deficiency or material weakness under those requirements. You've got plan participant entry failures. So you've got participants who are eligible to enter the plan, but weren't allowed to enter at the right time. Either they were allowed to enter too early, or they didn't get to enter at all, or they were allowed to enter too late. So that would be something where not only is it a compliance issue, but it also affects the financial reporting, because there could be over or under contributions in this scenario that would impact the financial statements. Another example here is your definition of compensation failures. This one's really common. Potentially, bonuses should be included in the compensation definition when you're determining the compensation base for contributions, but in practice, the bonuses are being excluded from the compensation definition. So you're not using the right compensation base, and contributions are underreported in that scenario, that definition of compensation failures. Though the bonus is the most common one that we see. One thing, though, I do want to point out here, one thing that we're seeing, and we saw last year in the 2020 plan year audits, was there were some new pay categories that got created due to the pandemic, right? There was COVID pay specifically, and that was a new pay category that payroll departments were needing to set up within the payroll system. And what was happening there is that those new wage categories should be part of your compensation definition, and contributions should be made on that new pay category, but that was getting missed in the setup of that new payroll item. So that's just something to keep an eye out for when new pay categories are created. Double check and make sure, should that be included in the compensation base for contributions in accordance with the plan document. So that was something I know we had a handful of clients that had realized it and caught it on their own before we started the audit, but that was something that we did see. So keep an eye out for that. And then another common one that we see that is an example of a reported finding and an internal control deficiency is the timeliness of participant contribution failures. Again, this is one of the more common ones that we see. And just a little reminder here, once you have 100 or more eligible participants in the plan, there's no safe harbor. You have to have the contributions put into the plan as soon as the assets can be reasonably segregated from the plan sponsor's assets. So for smaller plans a few years ago, they did put out a safe harbor rule for smaller plans that it was 15 business days from the payroll date. But again, once a plan reaches that 100 eligible participant mark, that 15 business day rule no longer applies. Once you're a large plan filer, then you have to do it as soon as your assets can be reasonably segregated. And that's on a case-by-case basis at each plan sponsor. So if you made that contribution within 2 days of your payroll date, and that's a pretty regular occurrence, and then you have a payroll where the person that's responsible for initiating the transfer of the contributions is like sick, and they don't have a backup person doing it, so you contribute it 4 days after the payroll date on one payroll, the Department of Labor would come in and say, hey, you established a pattern, you can segregate the assets in 2 days from payroll, within 2 days of your payroll date. So now that 4-day transfer is considered to be late. That's the one we see really common. It's really hard because there's no hard and fast rule on what's late. And the Department of Labor are the ones who gets to decide what late is. So in our auditor judgment, we try to help clients, guide them and say what in our judgment we think the Department of Labor would say in that scenario. But that's an example there, and a common one we see that would be both a non-compliance issue, timeliness requirements haven't been met, but it's also an impact on the financial statements because there could be lost earnings that need to be paid into the plan that haven't been paid in yet. And so that is an example that falls in both of those categories. One thing to make things a little bit better on this for everybody is that this written communication of these reportable findings is not required to be submitted to the Department of Labor with the 5,500. It just has to be given to management and governance of the plan. So that's a bright side there, that it's not like we're sending this all to the Department of Labor. It just needs to be reported to those two parties. Okay, I'll check the chat. It doesn't look like there's any questions that have come in here yet. So we will move on. Here's the third and final CPE code is report. Again, just jot that down and email all 3 of these to me after the presentation's done, and then I can send you your CPE certificate if you would like to get CPE for attending this presentation today. Again, that's the last CPE code, but this next part you're not going to want to leave because it's our regulatory update. But before I dive into the regulatory update, I actually wanted to show the difference between the old audit report under the limited scope audit standards and then what the new audit report is going to look like under the SAS number 136 audit standards, or the ERISA section 103A3C audit. So I'm going to pause the slides real quick and I'm going to show you. So just a reminder here, this is what the old audit report looked like. So it talks about the report on the financials. Management's responsibility is 1 paragraph. The auditor's responsibility is 1 paragraph. And then here it talks about that disclaimed opinion. So the opinion was disclaimed on the GAAP, generally accepted accounting principles. And then it talks about the supplemental schedules, the schedule of asset held. That's a common one. And then here's the opinion that is whether or not the report, the form and content is in compliance with DOL rules and regulations. So the opinion is last, and the management and responsibility and auditor responsibility are a paragraph each. So this is the old DOL limited scope audit opinion. So now I feel like there should be like a drum roll here. I'll show you what the new report will look like. And this example specifically is an example where it's the same auditor for both the current year and the prior year. And in the prior year, limited scope audit opinion was issued. And in the current year, the new ERISA section 103A3C audit opinion was issued. So before it was like a page and a half, and now it goes on to page, 4. So what is happening here is they have expanded a lot of the things that were going on behind the scenes with auditor responsibilities and management responsibilities. It's not that this is new, it's that they want it in the audit opinion now. So a couple things here is it talks about this scope and nature of this type of audit for this new ERISA section 103 audit, and that management has determined that this type of audit is the appropriate type of audit to be done, and that this certification has been obtained. And then the opinion. So here is the opinion that it's first now. And what they're calling this is they're calling it a two-prong opinion. So the first opinion is that the amounts and disclosures in the financial statements, other than those that are certified, are presented fairly in all material respects in accordance with GAAP, where before this was a disclaimer on GAAP. So now it's anything except for the information that's certified is in accordance with GAAP. And then for the information that is certified, that it is in accordance with the requirements of ERISA section 103A3C. So that is your two-prong audit opinion on the current year under the new standard. So then it talks about the basis of opinion, elaborates on things that the auditor is responsible there in accordance with the opinion. And then the responsibilities of management section. So before, remember, this was one paragraph. It's now 3 paragraphs. So it outlines some really specific things that management's responsible for here. And it took 3 paragraphs to do that. Again, not new, just now it's included in the audit opinion. So then the auditor's responsibility, if you remember, was 1 paragraph. Now it's a lot of paragraphs and bullet points. Again, nothing new here, just it's all put into writing in the audit opinion. Explicitly talks about how the audit did not extend to the certified information. And it's in accordance with GAAP other than the information derived there. And then now this new other matters section talking about those supplemental schedules that are required. The most standard one is that schedule of assets held at year end. So it talks about the supplemental schedules, how that information is obtained and what we do over the supplemental schedules, and then forming our opinion. Again, it's a 2-pronged opinion over the supplemental schedules. So it talks about how other than the information derived from the certification, and then the information that is derived from the certified asset information. So there's a 2-pronged audit opinion on the supplemental information as well, and that is new. Now, I'd mentioned the prior year audit was under the limited scope audit standards. So here you'll see that it's talking about the opinion on our auditor's report on the 2020 financial statements was under the CAFR, that was that limited scope audit CAFR, and then just a reminder what that report, how that report read. And that's the end. That was really long way to pretty much get to the same point that we were before, but it is different in that the auditor is not disclaiming their audit opinion on GAAP anymore. They are issuing a GAAP opinion and then issuing an opinion over the certified information under the Department of Labor standards. So check the chat really quick to see if there's any questions on that new and exciting audit report. I know you all are going to read it and be so excited to read it in detail when you get yours. It'll be like Christmas morning, I'm sure. Obviously, I'm joking, but it's pretty crazy. It's going from 1.5 pages to 4 pages. And I like to think everyone will read it in its entirety, but 4 pages is a lot of reading. So, okay, it doesn't look like we had any questions come in on that. So I am going to go ahead and jump back over to our slideshow and move into our regulatory updates section of the presentation. Get my settings here, good to go. Okay, so some regulatory updates here. I wanted to go back and just do a refresher on some of these things. Some of these things had a bigger impact on the 2020 plan year than it did on the 2021 plan year. But a lot of these amendments, these formal plan amendments that are now required, they have to be put into place by the end of 2022 for calendar year plans. So I wanted to just give a refresher on some of these, and then we'll touch base on some things that are newer as well. So for the CARES Act, some highlights and reminders. I'm not going to go into depth. When we first talked about the CARES Act and gave a presentation on it, I had like 6 more slides on this specifically. We all remember that really shook things up and added some new things that were now available because of the COVID-19 pandemic. So just a reminder, there was the new coronavirus related distribution that was created and the requirements around that and everything. That time frame has now closed where that's an option. That coronavirus related distribution is no longer even an option. But if you did elect to adopt that for your plan, you need to make sure that there is a plan amendment put into place, and that needs to be done by the end of this year, by the end of 2022, if you're a calendar year end plan. The other one was the plan loan availability and limits. Again, the time frame for that being an option has closed now, but that impacted the 2020 year plan loans. Waiver of the required minimum distributions for 2020. So those that were have met the requirements for needing to take that required minimum distribution, they did not need to do that for 2020. That was put back into place for 2021, and also it's still in place for 2022. And then lastly, there was the funding relief for certain defined benefit plans that was a result of the CARES Act. So just a reminder of a highlight that you did not have to adopt any of these CARES Act provisions. You could just adopt 1 or 2, but for any that were adopted, that formal plan amendment does need to be put into place before the end of 2022. And that wanted to remind you there. Double check the chat here, just see if we had any questions come in, and it doesn't look like we have any. So I'll move on to late participant contributions due to COVID-19. So the CARES Act created some relief where if there were participant contributions that were transferred late to the plan, and it's because everything was shut down, no one was working necessarily, or maybe the individuals that were in charge of this within plan management were out with COVID-19 and could not work. So what happened is the Department of Labor, the Employee Benefits Security Administration issued Disaster Relief Notice 2021-01. And what that does is it allows relief on late plan contributions solely due to COVID-19. And that was starting on March 1, 2020. And that goes through ending the 60th day following the announced end of the national emergency. So then I was like, oh man, is it still a national emergency? I was looking at this as I was preparing these slides, updating these slides the other day. So back in February of 2021, President Biden did issue a notice continuing the national emergency until March 1, 2022. And being that we had good timing on the date of this training last Friday, the president did issue a notice continuing the national emergency and extended it past to March 1, 2022. But I could not find that there was a specification on how long that extension would be. I'd be interested to see if any of you who are participating, if any of you saw something different there. I just saw that it was that they said it's extended past March 1, 2022, but I didn't see a date for how long it would be extended. So I'll check the chat to see if anybody found something I couldn't find, but That's the last that I could see there. So as of right now, if you did have late contributions solely due to the COVID-19 pandemic, that you do not need to report those as late. And that supplemental schedule for delinquent participant contributions would not be required because of that. Okay, I'm not seeing anybody coming up with anything new. So hopefully I got that right for you there, but we'll keep an eye on that too, because anticipating they're going to specify how long that national emergency will be extended for. Just know that it has been extended. So, okay, go on here to the next category for our regulatory update. So the Secure Act, if you'll remember, this got put into place at like the 11th hour, right at the end of December 2019. And most provisions of the Secure Act are effective for plan years beginning after December 31, 2019. There may be some exceptions to that, but I won't go over those here today. I do want to emphasize here that your deadline for adopting any Secure Act plan amendments, and these are all going to be required, is the last day of the first plan year beginning on or after January 1, 2022. Again, for calendar year-end plans, your Secure Act plan amendments need to be finalized and put into place by December 31, 2022. Couple of highlights. I didn't cover everything that was in the Secure Act. I tried to focus on those that would be most applicable to the group participating here today. But the Secure Act, just a reminder, it created this new category of pooled employer plans, or PEPs, you might have called these, that are required to be administered by a pooled plan provider. So these PEPs became an option effective for plan years beginning after December 31, 2020. And the differences here, you may have heard of a MEP, or a multiple employer plan, that were an option before. The differences here, just real quickly, MEPs that you had to be related. You had to have like a common purpose, members of the same industry to participate in a MEP. Well, with PEP, it's a retirement plan that allows unrelated employers to band together to join a 401k pooled employer plan. And the other thing that PEPs do is they removed what is called that one bad apple rule that exists under MEPs, where if you have a participant in a MEP and a plan sponsor who isn't following the rules, maybe isn't transferring contributions timely, things like that, that would cause problems for all of the participating employers in a MEP. With a PEP, they've said now that if you've got one bad actor, it doesn't have an effect on those who are participating in the PEP that are following the rules. So it got rid of that one bad apple rule under MEPs. So this is something that I know I've started to see activity on these new PEPs, but that is something that was put into place by the Secure Act. The objective of it being to make 401k plans more accessible, easier for small employers to offer. And that was kind of the motivation behind establishing that new type of pooled employer plan. Another Secure Act change is it increased the cap on payroll contributions from 10% to 15% for automatic enrollment safe harbor plans. So that's just applicable for plans that have elected to be safe harbor, but it did increase that cap. A few more things on the Secure Act I wanted to touch base on here. This one's a big one, and this impacts pretty much any employer of a plan, unless if it's a collectively bargained plan. This long-term part-time worker provision of the Secure Act does not apply to collectively bargained plans. Outside of that, what needed to happen was beginning 1/1/21, the plan sponsor needs to track the hours for all long-term part-time workers who work at least 500 hours because they will be eligible to make employee deferrals into 401k plans starting 1/1/2024. So that tracking needed to start happening 1/1/21 because it will be a 3-year look back. So at 1/1/2024, the plan sponsor will be required to do a look back and say, over the last 3 years, who are my long-term part-time workers who worked at least 500 hours in each of the last 3 plan years. That is why you need to start tracking it 1/1/21. And then starting 1/1/2024, those long-term part-time workers will be eligible to make employee deferrals. They do not have to be eligible for a match. They will not, those long-term part-time workers do not need to be part of your top heavy and discrimination compliance plan testing. They can be carved out for those purposes. But you want to make sure that you're tracking that because, like I say, it's a 3-year look back on those long-term part-time employees. Another provision of the Secure Act, just a reminder that it now allows, your plan needs to allow for up to $5,000 in-service withdrawals for childbirth and adoption expenses. So just a note here that this in-service withdrawal would still be taxable to the plan participant who took the withdrawal. It's just that there is not an early withdrawal penalty that would be assessed if it's up to $5,000 withdrawn for childbirth and adoption expenses specifically. So still taxable, but no early withdrawal penalty there. And that needs to be a provision that is in all plans now under the Secure Act requirements. And the last point on the Secure Act, this one was a big deal too, where it changed the minimum distribution age. It increased the age up from 70 and a half to age 72. So this Secure Act provision, this would only be applicable for individuals who had not reached age 70 and a half by December 31, 2019. So anyone who had reached age 70 and a half in 2019, they still needed to take required minimum distributions, even though they weren't 72 yet. It would be for people who are not 70 and a half before 1/1/2020 that this would be required on here. And so that now people who are taking minimum distributions, you need to be, it's not until you reach age 72. Looks like we had a question come in. It looks like, oh, a question. Great, I'm glad here. I had mentioned that the $5,000 for childbirth and adoption expenses, I had said that's required, but someone mentioned that that's optional. That it's a new type of in-service withdrawal, but it's an optional provision that not everyone needs to adopt. Thank you so much for that clarification on that. I really appreciate that. I get ahead of myself because some things in the Secure Act are required, but that one's optional. Thank you. Okay, I think that's my last piece on the Secure Act. Reminder there, and again, any of these that require plan amendments, those plan amendments need to be in place by the end of this year for calendar year-end plans. Okay, so the Consolidated Appropriations Act, this one was signed into law at the end of 2020, on December 27th, 2020. What it included here, one thing that it impacted ERISA plans was there's this temporary rule providing COVID-related relief from certain partial plan terminations. So just a reminder, under its Internal Revenue Code section 411D3, that there is this provision that says that if you have terminated a certain percentage of your plan participants within a plan year, typically what happened there is what's called a partial plan termination, where any of those participants who were terminated, laid off, that they immediately became 100% vested in their full balance. So if they had employer discretionary or matching contributions they were not fully vested in yet, At that point of partial plan termination, those terminated employees become fully vested. So what the Consolidated Appropriations Act said was, hey, if beginning March 30, 2020 through March 31, 2021, if the number of active participants covered by the plan on March 31, 2021 is at least 80% of the number of active participants covered by the plan on March 13, 2020, then there would not be deemed to have had a partial plan termination. Again, now the time frame on this is kind of past. I think most places are back to work, back to full capacity, things like that in relation to the pandemic. So this might not be something that's necessarily ongoing for anyone, but just wanted to remind people here, just in case that partial plan termination requirement was waived, as long as this 80% of number active participants covered requirement was met. Just wanted to remind people of that quickly there. Doesn't look like we have any other questions. I'll keep moving here. So the Department of Labor recently released cybersecurity guidance. And I wanted to bring this up because this is the first time the Department of Labor, the EVSA, the department, has issued cybersecurity guidance. And what they've done here is they've released this guidance that's best practices for maintaining cybersecurity for plan sponsors, for plan fiduciaries, for plan record keepers, and also for plan participants. And the guidance comes in 3 sections. It's out there and available on the Department of Labor website. There's 3 separate PDF documents is how they've released the information, how they release the guidance. And I have that downloaded and ready to go. If anyone's interested, I can send that to you if you don't want to spend the time finding it on the Department of Labor's website. But it comes in these 3 sections. So there's tips for hiring a service provider, cybersecurity program best practices, and online security tips specific for plan participants as they're logging in online to make changes to their participant accounts, and also to look at their participant account balances. So this guidance, the Department of Labor felt like it was important to put this out there because it's helpful to make sure that the requirements of ERISA are being met as they pertain to cybersecurity and protecting sensitive data. Your plan sponsors, your fiduciaries, your record keepers under ERISA, you have specific requirements that you need to be meeting when it comes to protecting that data and to cybersecurity. So I wanted to make sure to point that out and let people know that it's out there, because this is a good guideline of saying, well, what is the Department of Labor going to say I should be doing or did it or didn't do that then I've maybe not met the requirements for cybersecurity under ERISA. So this is some really great guidance and outlines what those parties should be doing for best practices in these areas. Okay, so that was my last regulatory update item here. I'm going to see, were there any questions on any of the regulatory update guidance before I circle back on a question that we got earlier? Just going to double check there if anybody did have questions or comments on that. Okay, real quick, I wanted to go back to this other question we got talking about the certifications. So the question that came in, I'll just read it here quickly to give some context on the question. So the question is a great one. It says, is it fair to assume the record keepers, for example, Fidelity, Empower, or Principal, will have the answers to the certification requirements where plan management's needing to really take responsibility here and understand this? It could be difficult for plan sponsors to agree to sign off on these items when they're depending on the record keeper to do this correctly. And this is a great question, because the certification itself is the responsibility of the record keeper. The certification is not the responsibility of plan management. It's plan management needing to determine if the certification is appropriate or not. And I haven't seen a law on this yet as far as have there been concerns with the plan custodian being able to provide a proper certification? So there's nothing new here. These are all the things that the plan custodian, that are certifying the plan assets, should have been doing already. So there may be questions that come up just because plan sponsors just weren't really aware of what all the requirements actually are. But I would hope that those plan sponsors would be ready, the custodians, your principals and empowers of the world would be ready and able to answer any questions that plan sponsors might have. I think the ones that are doing a good job will be ready for that. But from the trainings that I've gone to, and they were from the perspective of an auditor, of a practitioner such as myself, that a lot of those practitioners that early implemented the standard, they did have clients that had a lot of questions here. And that tool that I had shown earlier was really helpful in helping the plan sponsor understand the requirements. And then at that point, they could line that up with what that custodian had provided with the trust report and the audit package and the written certification. So I know that the auditors that I've spoken to were really helping connect dots there, but I didn't really ask if, that custodian, was principal providing some sort of help or documentation to help make sure plan sponsors are understanding it. So it will be interesting to see, or maybe if any of you, on the call or online with us, if any of you has seen anything on that. But a lot of what I've seen is the auditor was really helping the plan sponsor make sure they understood it and getting everything documented there, that management was taking responsibility, that the certification was in place correctly to allow for an ERISA section 103A3C audit to be performed. So great question. Thank you so much for submitting that. And with not having a lot of questions come in, we ended a little bit earlier than we had planned on, which is okay. We got the information out there, but did just want to thank everybody. Give it another minute to see if any other questions did come in. Again, a couple of reminders while we wait to see if there's any other last minute questions. This was recorded. We'll post the recording on our website. It'll be out there for those of you who maybe know someone who weren't able to make it today, or you wanted to watch this to refresh your memory later. We'll also make the slide deck available. And then for those of you who are participating virtually who wanted CPE for today, make sure you email me those 3 CPE codes that were spread out throughout the slide deck today. Email those to me at dnesbitt@larsco.com. Again, my email's up on the slide there if you didn't catch that earlier. Email me those 3 CPE codes, and then I can send you back your CPE certificate for your records so that you can get CPE for today. So I want to say, sorry we're ending early, but we're all busy. It's a busy time of year. And I think it's okay that we finished up a little bit early. It will just be 1 hour of CPE that we offer for the training today because of that. But otherwise, I want to thank everyone for participating. If you do have any other questions that came up, feel free to email me, reach out, give me a call. Happy to answer any questions that you might have. And just want to say thank you again for spending some time with us today. And I hope that everybody has a great day. Thank you, everyone.